Happy Thursday. Unfortunately, we are definitely still feeling some of the effects after the Fed meeting, so we're going to break this down and talk about some market trends here in the past week or so. My name is Steele, financial advisor with Mainsail Financial Group here in Bellevue, and our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out, especially lately, a lot of the noise along the way. We also have a great question of the week this week, which is how is Hurricane Ian going to affect the markets? So we'll come back to that, but the reason I'm bringing it up is that I'm actually heading to Florida coming up for just a weekend on the 14th, I believe it is. So this is quite the interesting time to be heading out that way. I'm interested to see, obviously, the damage. Hopefully everybody out that way, especially if you're out that way listening, I hope you're doing okay and family is safe. But we'll jump into things here this week, and then we'll wrap up talking about how Hurricane Ian, may impact the markets moving forward. First thing I want to touch on is consumer confidence. Number came out Tuesday at 108, which is great. Actually a very, very strong sign, much higher than expected, so it was good to see that. We also had pending home sales come out down 2% on Wednesday. Not the greatest sign. I think we all know some of the cracks in the housing market we're starting to see. This is another sign of that. It doesn't necessarily mean that the housing market is going to blow up. This may not necessarily mean a 2008 type of situation. There was a lot going on at that time, so keep that in mind. But we are certainly starting to see prices slow, and even here in the Seattle, Washington area, which has been a very booming market in the housing space, has started to slow down here a little bit. We also had initial jobless claims come out today, 191,000, which is actually a great number. Although if you're watching the markets, you may not really know it because markets certainly have had a lot of volatility. And really this entire week we've seen this, right? If we go back to the Fed meeting last week, we've just seen a lot of ups and downs. You know, yesterday was a great day in the market. Today is a down day in the market. You know, overall, obviously during that time, it has pulled back because it's very clear inflation is going to be persistent and the Fed is going to continue to raise rates and handle that inflation issue. I think that, you know, here we are near the lows so far this year, and we're probably kind of clearly seeing that might be a little bit of a resistance point. So will it bounce off from here? Will it drop a little bit further? Obviously, time will tell, but it's going to be a bumpy ride. And I think as we move into year end, the hopes is that maybe we start to see a little bit of growth from there. But, you know, again, this is a more real economic cycle than what we've seen back in 2020 with COVID, where it was just a quick drop and almost a faster rebound. This is going to take some time. It doesn't mean that we're going to see markets drop further from this point necessarily. It doesn't mean markets are going to stay where they are, but it's likely that we see a lot of volatility. We find some sort of price point before we really start to consistently pull out of this, you know, this valley that we're in right now. So again, it doesn't mean don't be invested. You should, because who knows how quickly that can happen. If we look back in August, we saw the markets pull back extremely quickly, and it shows how fast that can occur. That said, risk management is certainly just as important now as it ever has been, and what, you know, may have worked the last couple of years still may not be what works ahead. It certainly hasn't been year to date. So really important to watch that moving forward as we move into Q4 already. I don't know how it's almost October, but next week we'll talk a little about earnings as well coming up here shortly. Today we also had GDP revisions come out. No change on the GDP side of it. Gross domestic income, same story. It was up 0.1% last quarter, which again is why we haven't really felt like we were in a recession quite yet. But again, we are certainly watching what may be coming in 2023. The thing I want to mention on the recession front is just because we don't feel like we're in one yet, and it may be still to come, that doesn't mean that the markets react when we're in a recession. Markets typically are actually crawling out of the valley by the time we know we're in a recession. So that's very important to note. Lastly, for this week, I want to touch on our question of the week, which is how does Hurricane Ian impact the markets? And it's a very, very good question. Again, I hope everybody is doing well. Certainly hoping for everybody out in Florida that they're staying safe. But as far as the impact to the markets, the truth is that it has pockets of impacts. So for instance, you might have noticed just yesterday, companies like Home Depot, Lowe's actually had a big shot up. The reason for that is that hurricane season actually can typically be a time where they do a lot of sales, right? There's a lot of rebuilding that's going to need to be done, unfortunately, a lot of those challenges. And so a lot of times we'll see those impacts directly to the suppliers for these events. More broadly speaking, I think the more broad impacts might be around the travel industry to some degree. Florida is obviously a big hotspot. In fact, somebody might be going there in a couple weeks. But I think that's key. Now, that said, again, I don't think this is as big of a broad market impact, but there certainly are little pockets to consider and how it might impact things in the very, very short run. Obviously, we're talking about 30 billion, I believe 60 billion of damage, something like that. That's going to go somewhere that's going to need to be paid for, somewhere that's going to, kind of be pulled out of one sector and into another. And I think those are maybe some examples of where that goes. But keep in mind, that's very, very short-lived. Don't get me wrong, this is a terrible event. I hope everybody is okay. But at the end of the day, there might be some short swings here and there to account for it. I don't know that it necessarily has huge longer-term impacts anyways moving forward. So hopefully that's helpful. Very good question, very timely. And we will see you next Thursday as we get into Q4. I still can't believe it. And really address what we're looking at here in the quarter to come. Have a great upcoming weekend. We'll see you next Thursday at 3.